Well, why don't we go ahead and get started? I want to be careful with everyone's time. Can everyone hear me? Doing good? Okay, good. I'm Leanne Prendergast. I'm the chair of the iWork Florida Network. I'm so glad that you carved out some lunchtime today for us and for some free CLE, win-win. If you haven't heard of iWork, it's all about promoting and connecting women in the insolvency and restructuring industries. It's not just for lawyers, bankers, accountants, any professional. I would encourage you, if you don't know about iWork, to check out the iWork website. It's www.iwork.com. And your Florida network in particular is awesome. We just won the Ryan Award for Outstanding iWork Network. And one of our members, our own Judge Gentleman, won the Woman of the Year in Restructuring Award from iWork, and that's from iWork International. So we're doing good things here, and we hope to see you again. We're going to have our annual meeting November 16th, also via Zoom, although we might have some small kind of back porch type gatherings as well. More info will be coming out about that. And I'll turn it over to Jill and Carol.
Well, good afternoon. My name is Jill Kelso. I serve as one of the Orlando representatives on the Florida network of iWork, and together with Carol Fox, who's also serving as your one of the South Florida representatives on iWork Florida Network's board. We'll be presenting today on accounting and financial statements for lawyers. I'm just going to mention that while I am a trial attorney and appellate coordinator with the Office of the United States Trustee in the Orlando office, none of my comments here today can be attributed to the United States Trustee program or can be taken as an articulation of the program's policies. So with that, I would like to take a moment and introduce Carol Fox, who is our expert on the topic today. Carol is a senior managing director of B. Riley Advisory Services. She is a CPA with over 30 years of private and public accounting experience. Her practice for over 19 years has focused on providing forensic and investigative services to debtors, creditors, federal bankruptcy trustees, committees, examiners, court-appointed fiduciaries, the SEC, and the Department of Justice and other financial institutions. She enjoys a diverse practice. She has provided extensive restructuring and bankruptcy services and for distressed situations in the healthcare, life sciences, mining, education, e-commerce, and real estate sectors. She is a Subchapter 5 trustee for the Southern District of Florida and is currently serving as a Chapter 11 trustee in a case in the Eastern District of Kentucky. She's also serving as a state court receiver currently. She's also testified as an expert witness on numerous occasions in federal and state court, including testifying as an expert for the Department of Justice in the Chapter 11 bankruptcy case of Peabody Energy. Ms. Fox is a CPA. She's also has her certified insolvency and restructuring advisor credential, as well as is a certified fraud examiner. So with that, I would like to move over to just mention sort of the purpose and the thought behind the program today. I believe you all are probably keenly aware that a company's underlying financials dictate both legal strategies and overall objectives for a given company. It's critical to understand what a company's financials show you so that you can evaluate the best course of action for your clients. Today's course or program is intended to familiarize attorneys with the principles of the language of business or accounting to facilitate productive communications between attorneys, their clients, and other business professionals. We have an agenda here for you in the slides. I'm not going to go through it, but it is there for you. And I'd like to start off with asking Carol if you could please tell us why are financial statements important?
Thank you, Jill. So I think the most important thing about financial statements is that they help you understand your client's business. And for example, I just did an IDI about 30 minutes ago, and the debtor produced 2 years of tax returns plus their current year financial statement. And by looking at that, I could tell what the trends were in this debtor's business, who they paid. For example, this was a construction business, so they didn't have a very big payroll, but they paid a lot of subcontractors. In fact, all subcontractors. Only the only labor expense that was non-subcontractor related was to the principals of the debtor. So it gives you an idea of the debtor's business, or just the entity's business as it stands. You know, what is their revenue size? What's their expense size? And so just understanding overall the client is important. And then financial statements, I mean, just from a personal perspective, I'm selling assets right now for entities that don't have financial statements, and the sales process is really impeded by that. You know, I'm showing them cash flows that were created during the Chapter 11 period, but that doesn't really overcome the need for sound financial statements that third parties can rely upon.
Thank you, Carol. And I know in my cases, you know, financial statements are often helpful to obviously evaluate the debtor's financial condition and need, or course of action strategies throughout the bankruptcy case. They help us evaluate the performance during the bankruptcy case. As we're going to talk about, I think, Carol, they help in evaluating the viability of the business, or the possibility of a reorganization or other workout arrangements, help assess accuracy of projections, and look at the feasibility as a plan. And I think we're going to talk about some of those concepts as we move through the slides. And I'd like to head over to the financial statements. From a bankruptcy perspective, Carol, how do financial statements relate to the debtor's schedules and statement of financial affairs?
Okay, so I think that this is important, and because I am a CPA, you know, I take maybe a different approach to reviewing a debtor's schedules and SOFA than maybe an attorney would. And so the first thing I do is I look at the balance sheet, which should closely parallel the schedules. And so the balance sheet is a snapshot in a period of time. So even, let's just say you have a December 31st balance sheet, but the debtor files for reorganization or liquidation in the following year. Even at, let's just say, May of the following year, pretty much, barring any unusual or extraordinary events, the 12/31 balance sheet should give you an idea of the debtor's assets and liabilities. What would be on the schedules that may not be on the balance sheet are contingent liabilities. But in general, you know, if the balance sheet lists 5 cash counts, then you should probably have 5 cash counts on the schedules, etc. Same thing with equipment, etc. So let's just take an example. Let's say that there's equipment on the debtor's balance sheet as of December 31st, but no equipment listed on the schedules. Well, then that begs the question, where is it? The income statement is what occurs over a period of time. And so that ties into the SOFA directly to the questions, regarding how much has the debtor earned, in the years prior to filing the bankruptcy petition, and then again in the current year. And then the statement of cash flow, again, helps with evaluating where the debtor spent or generated a flow of funds. So it gives you, as the reader, an idea of the debtor's assets and liabilities, the debtor's income, and then the sources and uses of cash. And then if you're lucky enough, the notes to the financial statements would also give you a very good idea, and that's where I flip to first, if I'm lucky enough to have them. The notes to the financial statements provide a phenomenal overview of the debtor's business.
And what type, I know we have a slide about this later in the presentation, but you mentioned you look to the notes first, and what's an example of a detail you might find in one of the, in a note?
So the notes, I'll mention two that come to mind. Generally, the notes have a standard format too, just like the balance sheet. Starts with assets, then liabilities and equity. The notes, generally, the first note is always a description of the debtor's business. Then what also is in the notes that I like to read about are subsequent events. And usually in that note, they'll list any contingent liabilities or litigation. So that's where I start. Then there's standard notes that correspond to every item on the balance sheet, and sometimes the income statement as well, depending on how detailed the notes are.
And in your experience, do most entities or debtors have notes?
So I really think we've entered the age of QuickBooks financial statements, which are not so telling, and I would venture to say probably 80% of the people who are participating in this webinar have probably seen QuickBooks financial statements, and they're fairly devoid of details.
Understood. Okay, so we are moving over into some of the basic financial statement concepts, beginning with the balance sheet.
So, okay, so the balance sheet just generally, these are just kind of like, quick taglines. So when you look at a set of financial statements as the reader, your eyes don't just gloss over and you throw them aside and start reading the daily business review. The assets, generally tagline, what the debtor owns or what the entity owns. Okay, so and the key to assets are they're not written up or written down unless, well, they're not written up, but they are written down if they are impaired. And usually we don't get into a situation like that. But so the assets are on the balance sheet at historical, or what the value for which the debtors, or we'll just stick with the term debtors, that the debtors purchase the assets for less depreciation if they are depreciable assets, or amortization if they're amortizable. Liabilities, what you owe. So liabilities, accounts payable, notes payable, lease liabilities. And then you have what remains is your assets less your liabilities is your equity. So that is basically what is left in the business. So equity can be either a positive or a negative number, depending on whether the assets exceed the liabilities. That would result in a positive number, or if assets are less than liabilities, that will result in a negative number.
Thank you. And then the income statement provides what information?
So the income statement provides, it starts with, just starting over in the top left corner, we have the revenue. So the amount of money that the business generated from its customers before any expenses. So you have your gross revenue. And let's just go back to the construction company. So that would be all of the money that, based on the basis of accounting, whether it's cash or accrual, that the company generated from its customers. Next, this is particularly true in a construction company. Moving across to the top right, you have the gross profit, which is the revenue less the cost that were associated with generating that revenue, which is called cost of goods sold. Okay, so in the manufacturing or in the construction example, it would be all of the laborers that this particular entity was a roofing company. All of the roofers, the cost of the roofers, the cost of the supplies for putting on the roof. That's all deducted to come to gross profit. Those are expenses that are directly related to generating the revenue. Then you have bottom left, other expenses, which are just the costs that are necessary to run a business: insurance, rent,
an accountant, or
lots of accounting, legal, and then after you subtract that, you come to the bottom right, which is net income. So everything that what's left after you've subtracted out the expenses associated with generating your revenue, and then your overhead.
Thank you. And then we have our expenses.
These are some other things that we haven't really talked about, but I brushed on them briefly, and it kind of goes back to the schedules in a way. Expenses, okay, so expenses represent a consumption of assets during a period of time. So they could be both cost of goods sold or your general and administrative expenses. Depreciation is basically your capital assets, which are mentioned in the bottom left. So like your machinery, leasehold improvements, those are depreciated. And so depreciation represents the decline in value or the use over time. If you have a truck that you purchased today, it's not going to be worth the same as it is 3 years from now, and depreciation recognizes that. It allows for the recognition of the useful life of that asset being consumed. And then amortization is similar to depreciation, but that refers only to intangible assets, so assets you can't touch, trademarks, patents, copyrights, things of that nature. Customer list is also a good one, because we see that a lot in our bankruptcy cases.
Thank you. And let's talk a little bit about the methods of accounting. Carol, what are the differences in the various methods?
So there are two here, but there are a lot of methods of accounting. So we commonly see, I think in the debtor cases that we see, unless you're in a large mid-market case, you see the cash basis of accounting or the accrual basis of accounting. And so the cash basis of accounting, basically, that's prevalent in a professional services debtor. So, and by professional services, I mean doctors, lawyers, accounting practices. They generally keep their books on the cash basis. So, and cash basis basically means money in the bank and money out of the bank. There's no accrual for what might come in or what might go out at a later date, even if it relates to that reporting period. The accrual basis of accounting matches income and expenses to the period that they relate. So for example, if you're doing a 2020 financial statement, you would take into account all of the revenue that you've generated and all of the expenses that you intend to pay, regardless of whether they've been paid or not. One interesting part about this is that I found is that the debtor's basis of accounting can have a dramatic tax effect. I had a debtor a couple years ago that generated a significant amount of revenue. It was a wholesaler, but they kept their books on the cash basis of accounting, and they ended up owing a lot of tax post-petition when they were in dire straits because of the method of accounting that they chose. The method of accounting definitely has a kind of pay now or pay later type of motto to it.
Thank you. And I would just make a comment that in bankruptcy, debtors are obviously required, Chapter 11 debtors, I should be more specific, are required to file monthly operating reports prior to confirmation and quarterly operating reports post-confirmation. And I note that under the United States Trustees Guidelines, these reports are required to be prepared on a cash basis, although certain of the information in the reports is accrual information, such as accounts receivable and accounts payable. So if you're not accustomed to monthly operating reports, that they are required to be on a cash basis. So Carol, the presentation has some slides about GAAP, or generally accepted accounting principles. And in our discussions to prepare for today, we agreed that most debtors do not have GAAP financials. And that's been your experience, correct?
So most of the debtors that we have in Florida, unless they're in a mid-market case, unless they're a mid-market debtor, they generally, or unless their bank requires GAAP financials, they don't have GAAP financials. So I would say, by and large, the discussion of GAAP, or generally accepted accounting principles, is probably beyond the scope of today's conversation, and we agreed to acknowledge that the slides are in the presentation and for the audience's benefit, but we would move over just
that. Thank you, that's right. And so we're going to talk about the components of financial statements, and we'll start here with the classification.
Okay, so here we go. So we have current assets and current liabilities, and that's basically what you expect to collect or convert to cash, or what you expect to pay in a year. So classic examples of accounts of current assets and current liabilities are accounts receivable and accounts payable. Some debtors have accounts receivable and accounts payable aged past 360 days, and I would venture to say that they're likely not payable or collectible. Maybe payable, but the receivables likely not collectible. You haven't heard from your customer in a year. Good luck with that. So, and then we have, moving over to the right, we have non-current assets, non-current liabilities, and those are same concept, but assets or items that are expected to be converted into cash or paid with beyond a year. So for example, a building, machinery, equipment, long-term debt, a mortgage. Those are all examples of items that you would not expect to sell or pay in a year.
Okay. So if we take a look at an example, here's an example financial statement for Acme Company. One of the questions I had in looking at this, and going back to what you said earlier about how equity can be either positive or negative, does a company's negative equity correlate or mean that that particular entity is insolvent?
So, so that's an interesting question, because looking at this entity, you would assume, since they have positive equity, meaning that the retained earnings on the far right up in the balance sheet, $500 where the arrow is pointing, is positive. This would indicate solvency. But insolvency principles under the bankruptcy code require that assets are recorded at fair value. So I will mention that this particular company is a little bit easier, because we'll see in the next slide, I think that they're in their first year. So it's easier to make projections about accounts receivable, inventory, property, plant and equipment, but all of those things, all of those assets need to be recorded at fair value, and that's not what's recorded here. That these financial statements are at historical value. Additionally, insolvency would also, under the bankruptcy code, would also allow for contingent liabilities, which would not be a component of a financial statement. So on face value, yes, this looks like a solvent entity, and I would venture to say it probably is, but this is not usable for an insolvency or solvency insolvency analysis.
Thank you. That makes sense. And
so the reason why we know just that it's in its first year is because cash at the beginning of the period, right, the dash right below the bottom number of $500 is zero. So we know that this business is in its first year or so. But to my point a little bit earlier and what we were discussing about, this nicely lays out what the debtor did with their money in its first year of operations. So they increased their accounts receivable, they increased their inventory, other assets, and then moderately increased their accounts payable. Then additionally, they purchased some property, plant, and equipment, and then they financed all of the above with an infusion of equity, common stock. Okay, so this is one of my favorite slides in this presentation, and this is the motto of this slide is 1 year of financial statements does not tell the picture or tell the story of the debtor. So never ever, and I mean, I guess sometimes you're stuck, right? Because in the prior example, that was all that debtor had produced
in their first year.
Mm-hmm. But this is a classic example of 1 year doesn't tell the entire story. So we'll note that 1999 was the most profitable year for this debtor. They generated about $337,000 in operating income. And that's because during the period, the cost of goods sold and SG&A, which is selling and general and administrative expenses, which is your overhead, remained in line with their sales. But then when you move over to the next year, this debtor had $15.7 million in sales, which sounds great. I mean, it's an increase of over $6 million from the prior year. That's awesome. But it took them nearly all of that, $14.4 million to generate that. So that's not so great, because then they're very thin to meet their selling or their overhead. So that resulted in a loss.
Carol, can I interrupt you for 1 second? We had a question on the chat. What is SGA again?
It's your overhead, selling, general, and administrative expenses. So it was the same thing as what we talked about in one of the slides prior. It's not the cost of goods sold, but it's the cost of running the business.
Thank you.
Sorry, if I'm going too fast, just slow me down. Once I get started, I'm a bit like a runaway train. So then in the following year, sales went back to a level that's consistent with 1999, but again, the cost of generating the revenue, also the cost of goods sold also went back in line, but this business's overhead, the SG&A, was too high for that year on a percentage basis. And how you judge that is by the percentages next to the numbers. All of the numbers, so for example, just using 1999 as an example, all of the numbers, cost of goods sold, gross profit, operating expenses, and operating income are all expressed as a percentage of sales. So sales is the anchor, it's 100%, and then everything else is a percentage of that. And that's the same methodology applied for every single year, so you can see the trends, realizing that there's good years and bad years in a business. The percentages should really remain fairly consistent year over year. So that's what the percentages allow for variances in revenue and expenses as they're expressed as a number.
So in general terms, Carol, what can we learn about the business by looking at this 3-year analysis as opposed to a single year?
So we learn here, this tells us what happened to this business, and if they, let's say that they do file, we can see from a business perspective that some of the contributing factors would be that they may not have properly managed their business. So for example, the cost of goods sold in 2000 was way out of line with the amount of revenue that this business generated, then they seem to correct that problem in the following year, but then their selling and general and administrative expenses were too high. It may also tell us too, though, that there might be inconsistencies in this debtor's accounting, meaning that items that were in cost of goods sold maybe in 2000, they moved to selling and general and administrative expenses in 2001.
So does this help us recognize something that may be sort of an impact from something like our current situation from COVID? I mean, I know in a lot of the bankruptcy cases that I'm seeing, and you know, lately they've all mentioned as a reason, one of the reasons for filing is certainly seemingly stemming from COVID. Would we be able to tell something like that in these numbers here?
So that's a really good question, because in a lot of my subchapter 5 cases, they also cite COVID as a reason for filing. And so one thing that has to be produced in the debtor's initial interview is our tax returns. So if we had tax returns indicating that the debtor lost money, you know, in not only 1 year, but 2 years prior, we would probably cast a suspicious eye as to whether COVID was actually the decline for their business, or that the debtor had just gotten to the point where they were so thinly capitalized that recovery in a COVID situation was impossible.
That makes a lot of sense. And then let's move over. I think we were done with the common sizing, and thought we would move over to the budget to actual information that we often see in a cash collateral context, and just wanted to talk generally about this.
So the budget to actual is really important, and again, I track this very aggressively in my subchapter 5 cases where there is a cash collateral order, and if I don't feel comfortable, I actually request that the debtor goes. They like to get to as large of a period as they can. They're like, oh, well, how about a month? I was like, well, you know, that kind of aligns with your monthly operating reports. How about every 2 weeks? That would work a little bit better. Filed 1 week after the reporting period ends. And so what this helps is with identifying problems and the feasibility of reorganizing a debtor before you get too far down the road. And I ask a lot of questions, and just because the debtor's cash balance may be growing may not necessarily be a good thing, because if their cash balance is growing but they're not paying critical vendors and they're accruing administrative expenses during the bankruptcy period, then you know that's really
would that be in other words, their cash looks like it's getting, you know, they're amassing cash, however they're also amassing debt by not paying their payables, basically?
Correct. And that's my point. And so and just linking into the slides and knowing the debtor's business, like let's take the manufacturing example again. Let's say that, because usually on the budget to actual, it's very, very specific what they're using the cash for, that's usually required. So let's use the manufacturing and the roofing example again. Let's say the cash balance is going up, but they're not paying anything for roofing supplies. So to me, that means that they're either not they don't have any jobs going on during the current period, or they're not paying their critical vendor for roofing supplies. Same thing with like subcontract labor. So, so by looking at the past or the historical financials that we looked at previously, you have a flavor of what the debtor's business should look like going forward. And then if those expenses aren't being paid, you need to ask yourself, you know, is this debtor actually operating, or are they not paying their bills as they become due?
Understood.
Can I interrupt with another question from the chat?
Yes, please. Thank you.
The question is, remind us what EBIDTA and EBT are.
Okay, so EBITDA, which is number, I can't see it, it's right here.
It's 16, it's line 16.1 and 16.3 and 16.5.
Okay,
and then,
so earnings before interest, taxes, depreciation, and amortization is EBITDA. And then earnings before interest, and taxes is EBIT.
and that is 16.
And then there's a funny joke that I'll throw in here. It's a corny accounting joke. We call it EBITDA. Earnings before interest, taxes, depreciation, amortization, and coronavirus. It's an accounting hot pot. It's such a corny accounting joke, but every CPA has seen it now, so I just thought I'd throw it in
It's
there.
just shocking to me that accounting jokes would be corny. I don't understand.
Yeah, or even remotely funny.
One more question from the chat. Where do we see total cash and total debt accruing?
So you wouldn't see, that would just beg the question. Here, this particular budget shows the uses of the DIP loan, the debtor in possession loan. So this is showing the drawdown on the or increase of the DIP.
And I just have a question, Carol.
So the answer is it's not on here, but then what you would do is that you would ask the next question, show me your cash receipts, show me your payables.
And can I put you on the spot, Carol, and ask you, when I look at budget to actual for each of these time periods, they're like the net income at the very bottom, they're very different. Like, you know, at first it looks the actual was better than the budget. Great.
Right.
Next time period, no, not so much.
Yep.
The next one, very different. And the next one, very different. Would this alarm you, or it just causes you to ask questions? Like, show me.
No, I mean, I would probably look at it, Leanne, more over like a monthly basis. It's really hard to predict out, and I've done it as a financial advisor. It's really hard to predict cash and expenses on a weekly basis. So I would probably, with respect to that, look at it more on an aggregate basis, total budget to total actual. I mean, I guess if you went 5 weeks or so and you were still totally off budget, or maybe even 3 on an aggregate basis, then I would start asking the debtor if their projections were really accurate, or if they needed to go back and revise them for some reason.
Good to know. Thank you.
So, moving on to the statement of stockholders' equity.
So this is really more of just an extension of our prior conversation regarding, in our case, it would be solvency versus insolvency. One interesting part about this is that it does put into play the distribution, so the amount of money that the principals of the debtor are taking out of the business.
Okay. And we talked a little bit already about the notes to the financial statements and the fact that many don't have such notes and some of the information that's contained in there. I don't know if there was anything else that we wanted to mention about those.
No, I'll open it up to the audience in case they have any questions. Okay.
Just on the notes. And okay, it doesn't sound like it. Leanne, did you see anything in the chat?
Not yet.
Okay, so
Oops,
when we
wait.
go, oh,
Sorry. There is one. I missed it. What kind of issues would be hiding?
So I think one important thing is probably significant litigation. Related party transactions. I think parties are like, let's say this, we'll just continue with the roofing example. Let's say that your best customer or your most important customer was your brother's business. Okay, well, that's a good thing to know. Also, if all of your business is pushed toward one entity, like your key customers, like say you only have 5 key customers, that's information that you need to know, because if one of those customers becomes insolvent or has their own internal problems, then your business will likely be affected. So what the notes point out are things that aren't necessarily included in the financial statements. So again, like significant litigation related party transactions, key customers, that might be a disclosure. And those are all things that are important to know about the future operations, the current and future operations of any company.
that certainly makes sense. And Carol, we talked about ratio analysis and that we weren't going to get into sort of the nitty gritty of it, although there's some details in the slides. Can you explain a little bit about what they are and give us some basic rules of thumb?
Sure. So ratio analysis is a lot like common sizing from slide 20. It gives us some trends, and so we need to bear in mind, as we did with slide 20, that ratios vary from industry to industry. So that's important to realize. That maybe a professional services industry versus a manufacturing industry versus a big box retailer, their ratios are going to be different. But what ratios tell us in general is, for example, we have on the slide that we are right now, they give us some additional tools to forecast and review the operations of the business. So here we have, for example, the current assets or the working capital ratio, which is expressed as current assets divided by current liabilities. So if that number is less than 1, you're generally looking at a very thinly capitalized business that is going to require something more than the cash or receivables on its balance sheet to pay its current obligations, like maybe a credit line or something like that would be a non-current liability. So this generally shows how the cash and the assets that can be converted into cash within 1 year cover the debts that are going to be due in 1 year.
So, and that's an example, and we have some others in the slides. And I note that if any of the attendees would like to have a copy of the slides, we're happy to provide those. But we have about 10 minutes remaining, and I wanted to jump ahead to what we describe in the slides as legal matters. And, you know, there's a number of examples that we have here as to the interplay of accounting and different legal matters. You can see some of the ones that are on the screen. I'm going to go ahead and jump to what we have listed as the last category, which is some of the bankruptcy legal matters and other, you know, financial related issues. And ask, in your experience as both an expert or a professional in some of your cases, what are you doing most frequently? Oh.
Is that a question for Carol? I'm sorry.
Yes, that was for Carol.
Oh, I'm sorry. I thought we were opening it up to the audience. I apologize.
Well, we can, I mean, we have about 10 minutes, so I just wanted to do sort of a quick overview of some of the more frequent, you know, where the interplay with the accounting and the bankruptcy cases come together. We obviously know that they're really, you know, dependent on one another, but what are you looking at most frequently?
So in my subchapter 5 practice, I see a lot of, unfortunately, businesses that were experiencing issues pre-COVID and then maybe got a PPP loan and as a last breath of air before filing. And so not all, but most of my cases that are subchapter 5 have PPP loans, and most were expended prior to the filing. So I see a lot of that. I see a lot of businesses that just really maybe suffered from what we discussed earlier, maybe improper management, and now it's too late to reorganize during COVID because we are in, quote, unprecedented times. And so that's very cliche, but also very true. So it's very difficult to reorganize right now because we don't know what the future is going to look like. That's particularly true for a field that I'm very involved in, which is healthcare. So, for example, surgery centers don't know if there's going to be another suspension in elective surgeries. And so, I mean, especially surgery centers, which are all elective surgeries, a lot of them had their stream of income suspended for about 5 months. And we don't know whether we're going to go back to that. So I think that there's a lot of, in the bankruptcy world, a lot of angst and anxiety regarding the future because it's not the same. And then that compounded with I think just the upcoming election. I mean, we can't, as much as we would like to, you know, run away and hide, it's going to happen, and that's also going to have an effect. So I would put out there that in addition to an already tricky situation with filing for bankruptcy, then there are, you're asked as a debtor to come up with a plan of reorganization based on a very sketchy future or at least near-term future.
Yeah, and I know, I mean, every one of my Chapter 11 cases that goes to confirmation, I look at the projections that are, you know, attached to the plan and disclosure statement and try to match them or at least compare them to financial performance prior to the case or and financial performance during the case. And right now, with the uncertainty that, you know, the uncertain times, I think, you know, you got to give a little leeway on the projection side of things, because it's just, it may frankly be impossible to nail it down in the current climate. But I think we have maybe just a few minutes left. If there are any questions in the chat, or if anybody would like to put some questions in the chat, we could take this time to answer your questions. Leanne, I'll ask for your help there.
Yeah, I'll keep an eye on the chat. And then I did want to just say, I forgot to say at the beginning, I can, using the emails that people registered for this event with, I can email out the bar certificate to report the CLE to the Florida Bar, and also the slideshow and a video of the presentation if you guys want. I think I can figure that out.
Okay, thank you. And I'll just say, in the chat, if y'all look at the chat, I did put the CLE course number there. We tried to insert the a copy of the accreditation slip from the Florida Bar, but the CLE course number from the Florida Bar is 2006 008 N as in Nancy. So 2006 008 N. And I guess if there are no questions, I would just like to mention that through our iWork Florida network, we have a number of folks that are serving on our board who, like Carol, are Subchapter 5 trustees, and we are planning to, I would say, sometime after February, which would be approximately 12 months after Subchapter 5 became effective, to host another CLE that will talk about sort of the lessons learned and where we see these cases going and how best to optimally navigate a Subchapter 5 case. So look for that. That's going to be forthcoming. And if there are no questions, I would just say thank you so much, Carol. We really appreciate your time and effort in sharing this with us today.
I muted myself. I apologize. There is a question.
Oh, good. Okay.
Do Carol or Jill have questions to help debtors prepare better statements in Chapter 11s? Do they necessarily need to hire outside accountants?
So that's a good question for me, because when I interviewed for Subchapter 5, and I know this presentation isn't about Subchapter 5, but they the United States trustee really looked for Subchapter 5 trustees with financial advisory experience. And so I didn't, at the beginning, I didn't know how much to offer or not to offer. But I mean, I've gone as far as formatting the debtor's projections. So I would say that, I would say that probably the purpose of Subchapter 5 is not to hire a financial advisor and rely more on the Subchapter 5 trustee, but I'll say also that with the increase of the debt limit, I was talking to one of Jill's colleagues earlier today, and he was telling me about a case where the debtor was publicly traded. Holy moly, get a financial advisor, please. Because
yeah.
I mean, the smaller cases, definitely the Subchapter 5 trustee can help, but a case like that that's publicly traded, no. So
I mean, there are lots of other issues there. I think, go ahead.
No, I'm sorry. I have helped my debtors substantially, and in fact, today in the IDI, I offered. They said, "Well, we might hire a financial advisor." I said, "If you don't need to, I'm happy to help." And so,
yeah, and I think it's. I would say, and this is my personal opinion, nothing to be attributed to my program, but It really does depend on the level of sophistication of the debtors, because I've had cases where, I mean, they come to the 341 meetings and really hadn't even considered putting a budget together. And you're never going to really be able to evaluate how to optimally operate the business if you're not looking at where your money's coming from and where it's going and what you have. And so I always encourage folks to at least do a deep study of their financials. And you know, a lot of the I would say less sophisticated debtors arrive without perhaps having done that, which in part could be contributing to why they're here. So, you know, I also, on the legal side of things, question situations where I see debtors counsel preparing the projections, because unless they want to take the witness stand to support them and explain why they, you know, came up with, you know, certain numbers, then that's a really risky proposition. And so, you know, I think it really depends on the circumstances. I mean, if a company shows up and it really is, you know, they have attained operational efficiencies, but, you know, they suffered a bump in the road and their financial documents and statements are in order, then it's not really the driving issue as to why they've arrived. But at times, just the lack of financials can be the reason, in part, why they don't know what their own inefficiencies are. So it really is sort of a case-by-case analysis.
I 100% agree with Jill, and I'll say that all of my remarks are predicated on having a debtor with an experienced bookkeeper at a minimum, because if the financial statements are in disarray, I can't help. I can't recreate data that's not there, but I can assist with assembling it into a format that the courts can understand. And by no means would I ever do the debtor's projections. I only vet them.
That makes sense. Anyone have any other questions? All right, well, I think we'll wrap up. It's 1 o'clock, and we promised we'd be careful with your time, so we will let you go. I'm so glad, Jill, that you thought to mention the subchapter 5 presentation that we're going to do. I think that's going to be one to catch as well, and we'll be sure to be emailing you guys about that. Thank you, everyone.
Thank you all.
Thank you.